Listen to me very carefully, because what just happened in the markets today is exactly how retail investors get slaughtered while the smart money gets filthy rich. Gold just blasted through the stratosphere. It ripped past $5,300 an ounce. The world is quite literally on fire. Oil prices just exploded by nearly 10% over the weekend, and billionaires are panic buying gold like it's the last lifeboat on the Titanic. But silver? The so-called poor man's gold? The metal that is supposed to fly like a rocket when gold moves? They dumped it. Silver just crashed 7% in a single session. While gold owners are popping champagne, silver investors are staring at their screens, absolutely paralyzed, watching their portfolios bleed out. I've seen the forums. I've seen the comments. People are panicking. They're selling at a loss. They're screaming that the silver market is permanently broken. But here is the absolute truth. The reality that the mainstream financial media is too terrified or too clueless to tell you. This wasn't an accident. This wasn't a glitch. And it certainly wasn't because silver lost its value. This was a calculated, precision-guided assassination of retail stop losses. By the end of this video, you are going to understand exactly who dumped silver today, why they needed you to panic, and the terrifying macroeconomic trigger that is about to snap this 7% drop back in the other direction like a coiled spring. If you hold physical silver, or if you are even thinking about buying the dip, what I'm about to show you in the next few minutes will be the difference between you becoming a casualty of this market or coming out on the other side with generational wealth. To understand why your silver got brutally sold off today, you have to understand the nightmare scenario that just unfolded on the global stage. We aren't looking at normal market conditions anymore. As of today, March 2026, we are looking at a fundamentally broken global architecture. Over the weekend, we saw coordinated, unprecedented military strikes in the Middle East. The direct conflict between the US, Israel, and Iran has escalated to a point of no return. The headlines are flashing red. But it's not just the kinetic war that the markets are reacting to, it's the economic fallout. The Strait of Hormuz, the most critical energy choke point on planet Earth, is under direct threat. Almost immediately, algorithmic trading bots and institutional money managers looked at the map, looked at the supply chains, and slammed the panic button. Brent Crude Oil spiked nearly 10% in a matter of hours. Do you know what a 10% overnight spike in crude oil means? It means the cost of manufacturing everything, shipping everything, and powering everything just skyrocketed. It means the inflation crisis that central banks claimed was under control is about to roar back to life like a cornered beast. When institutional money smells war and hyperinflation at the exact same time, they don't buy tech stocks. They don't buy bonds. They buy gold. That is why gold hit $5,310.27 today. It acted exactly as it has for 5,000 years. It was the ultimate undisputed safe haven asset. It was the anchor in the storm. So, basic logic dictates that if gold goes to the moon, silver is strapped to the exact same rocket ship, right? Wrong. And here's where the trap was set. If you want to survive in the silver market, you need a radical identity shift right now. Stop thinking like a casual investor who just looks at the gold-silver ratio and assumes one automatically follows the other. You need to start thinking like a predator. Gold is purely monetary. It is money. It sits in vaults and looks pretty while protecting purchasing power. But silver has a split personality. It is a monetary metal, yes, but it is also the most highly conductive, heavily utilized industrial metal on the periodic table. You cannot build a modern missile defense system without silver. You cannot build a solar grid without silver. You cannot build EVs or high-end electronics without silver. Roughly 50% to 60% of all silver demand is strictly industrial. And that, my friends, is the excuse the big boys use to dump the price on your head today. When the news of the Middle East escalation hit and oil spiked 10%, the market suddenly priced in a massive global recession. The logic, or at least the narrative they sold to the algorithms, went like this. If oil is too expensive, factories will shut down, supply chains will freeze, nobody will be building new solar panels or EVs because the global economy is grinding to a halt. Therefore, industrial demand for silver is going to crater. They spun a narrative of an industrial freeze. While gold was catching a pure safety bid, silver was being treated like copper. It was being traded like an industrial commodity about to hit a brick wall of zero demand. That was the primary driver that pushed the price down. But if you think that's the whole story, if you think a 7% crash is a natural organic reaction to supply and demand, you are being played for a fool. Let me introduce you to the real villains of today's market action. The bullion banks, the paper market makers, the guys sitting on trading desks who control billions of dollars in highly leveraged futures, contracts on the COMEX. You need to understand something fundamental about the silver market. The paper price of silver and the physical reality of silver are two entirely different universes. For every 1 ounce of actual physical silver sitting in a vault, there are hundreds of paper contracts trading hands, pretending to be real silver. The institutions control this paper market, and they know exactly where your breaking point is. Coming into this weekend, retail excitement for silver was at a fever pitch. The technical charts were flashing bullish. Retail investors, feeling the inflation pinch, were piling into silver ETFs, buying call options, and placing their trades with tight stop losses, meaning if the price drops by a certain percentage, their broker automatically sells their position to limit the damage. The institutions saw this. They saw a massive pool of liquidity just sitting there, waiting to be harvested. So when the war news hit and the industrial freeze narrative provided the perfect cover story, the big banks didn't just sit back, they weaponized the news. During the lowest liquidity hours of the trading session, when the Asian markets are handing over to Europe and the US is still asleep, they dumped massive, ungodly amounts of paper silver contracts onto the market. They slammed the bid. Why? Because they knew exactly what would happen. By aggressively shorting paper silver and forcing the price down 2%, they triggered the first wave of retail stop losses. When those retail accounts automatically sold, it pushed the price down to 3%. That triggered the next wave of stop losses, down to 4%, down to 5%, panic set in, margin calls went out. By the time the US markets fully opened today, the algorithms had taken over, relentlessly selling, and silver was down a brutal 7%. It was a textbook, precision-engineered flush. They manufactured a panic to steal your position. Let me give you a real-world example of how this plays out. Let's invent a guy, we'll call him Paper Hands Paul. Paul is a smart guy. He reads the news. He sees inflation rising. He knows fiat currency is losing its purchasing power. So 3 weeks ago, Paul decides to protect his family's wealth. He buys $10,000 worth of silver through a popular ETF or a leveraged futures platform. He feels great about it. He sets a stop loss at 5% below his purchase price because some trading guru on Twitter told him to always manage his risk. Then today happens. Paul wakes up, grabs his coffee, opens his brokerage app, and his heart sinks into his stomach. The screen is bleeding red. Silver is down 7%, but Paul doesn't even have a choice to hold. His stop loss was triggered 2 hours before he even woke up. His broker automatically sold his position at the absolute bottom of the panic spike. He locked in a devastating loss. Now here is the million-dollar question. I want you to really think about this. When Paul's broker automatically sold his silver at the bottom, who do you think was on the other side of that trade buying it? The exact same bullion banks that initiated the paper dump in the first place. They shorted the market at the top to trigger the panic, drove the price down, forced retail investors like Paul to puke up their shares at rock bottom, and then the banks scooped up those exact same positions at a massive discount. They legally robbed the retail market in broad daylight, and they used the geopolitical chaos as their smokescreen. Here is the contrarian truth that separates the wealthy 1% from the constantly losing 99%. You are not a day trader. Stop acting like one. If you are treating physical silver a hard asset with intrinsic value like a volatile tech stock that you try to scalp for pennies, you are playing a rigged game that you are mathematically guaranteed to lose. You aren't a trader trying to catch a quick rally. You are a resource accumulator preparing for the greatest wealth transfer of our lifetime. When a 7% paper crash happens, the amateur sees a loss. The professional sees a massive neon flashing discount. Think about the sheer, undeniable reality of the physical market right now. Have the silver mines suddenly discovered massive new veins of ore? No. Global mine supply has been largely flat or declining for years. Did the military-industrial complex suddenly decide they don't need silver for their missile guidance systems, especially with a massive war breaking out? Absolutely not. Did the shift toward green energy and solar panels miraculously stop overnight because oil spiked? No, an oil spike actually accelerates the desperate global push for alternative energy, which requires thousands of tons of silver. The physical reality has not changed. The only thing that changed today was the digits on a digital screen, manipulated by people who desperately want you to hand over your hard assets for worthless fiat currency. Before I expose the absolute massive catalyst that this 7% drop just set up the rubber band effect that I am tracking closely, I need to know where you stand right now. I want you to go down to the comments right now. Are you buying this engineered dip, or did this morning's paper crash shake you out of the market? Type buying the dip or staying away in the comments below. Let's see the real sentiment of this community, because I guarantee you the institutional algorithms are scraping social media sentiment right now to see if their panic tactic worked. Prove them wrong. All right, you understand the macro nightmare. You understand the industrial freeze narrative. You see exactly how the paper manipulators hunted your stop losses. But here is where the story gets absolutely insane. Because what the bullion banks just did today, they just lit a fuse on a physical supply shortage that is going to make this 7% drop look like a rounding error. While they were playing games with paper contracts, the physical premiums, the actual cost to get a real silver coin delivered to your door, just started doing something very, very strange. The physical market is breaking away from the paper market. And when that rubber band finally snaps, we are going to see a violent upward correction that will catch 90% of the market completely off guard. Welcome to the real world. While the paper manipulators were crashing the silver spot price by 7% down to $88.50 an ounce, the physical market was doing something entirely different. The physical market is breaking the matrix. And if you aren't paying attention to the premiums right now, you are going to get completely blindsided by what happens next. Let me break down the greatest illusion in the precious metals market, the spot price. When you see a headline screaming that silver crashed to $88.50 today, you naturally assume you can take your $88.50, walk into a local coin shop, and walk out with an ounce of silver. Try it, I dare you. Go online right now to any major bullion dealer. Go to APMEX, JM Bullion, SD Bullion. Look at the American Silver Eagles. Look at the Canadian Maples. Are they selling for $88.50? Absolutely not. When the paper price gets violently shoved down by the COMEX manipulators, the physical dealers do not panic. They know it's a fake out. So what do? They instantly jack up their premiums. The spot price goes down 7%, but the premium goes up 15%. The actual real-world cost to acquire physical silver hasn't crashed at all. The gap between the fake paper price and the real physical price is stretching like a giant rubber band. Think about the psychology here. The bullion banks are trying to scare you into selling your physical metal at $88.50. But if you want to buy it back tomorrow, the dealers are going to charge you $105. It is a one-way extraction of your wealth. And history proves, without a shadow of a doubt, that when that rubber band snaps, the paper price violently slingshots upward to meet the physical reality, every single time. But here's the part that should terrify every Western investor who sold their silver today. Who do you think is backing up the truck and buying all of this discounted metal? It's not your neighbor. It's not the guy day trading on Robinhood. It is the East. While Western retail investors are getting stopped out of their leveraged positions and crying about a 7% drop, Eastern central banks, institutional buyers, and retail giants in China and India are vacuuming up physical silver at a record historic pace. They are looking at the exact same geopolitical chessboard that we are. They see the Middle East in flames. They see Brent crude spiking 10%. They see gold blasting past $5,310. And they know that fiat currency is dying. But unlike Western traders who play games with paper contracts, the East demands physical delivery. In the Shanghai Gold Exchange, silver trades at a massive premium compared to London and New York. Why? Because the Chinese market actually respects physical reality. They are draining the Western vaults. India just imported more silver in the last quarter than they usually do in an entire year. They are taking our silver, and we are letting them do it because we are too obsessed with a red ticker on a screen. When the East drains the physical vaults, the COMEX paper game collapses. You cannot short 1 billion ounces of paper silver if there is no physical silver left to back it up. That is the end game. And today's manufactured panic was just another wealth transfer from the West to the East. Remember when I explained the industrial freeze narrative? The excuse the banks used to dump the price? They claimed that because oil spiked 10% over the weekend, the global economy would slow down and nobody would need silver for solar panels or electric vehicles. That is the biggest, most mathematically illiterate lie currently circulating on Wall Street. Let's use basic logic. When the Strait of Hormuz is threatened and the world suddenly realizes that Middle Eastern oil is no longer a guaranteed stable supply of energy, what do governments do? Do they say, oh well, I guess we'll just stop using electricity? No. They panic and they massively accelerate their push for energy independence. A spike in crude oil does not kill the solar industry. It throws gasoline on it. When oil is prohibitively expensive, the ROI on a massive solar grid suddenly looks incredibly cheap. Governments in Europe, China, and the US will print trillions of dollars to subsidize solar infrastructure because it is no longer just an environmental goal, it is a matter of national security. And you cannot build a high-efficiency solar panel without silver, period. There is no viable substitute that conducts electricity as efficiently. The demand for industrial silver is not going to freeze. It is about to go parabolic. The very event, the oil spike that they use to crash the price of silver today, is the exact same event that guarantees an astronomical physical shortage tomorrow. Don't take my word for it. Look at the raw, undeniable data. For the past several years, the Silver Institute, the leading authority on global silver supply, has confirmed we are operating in a structural, massive deficit. We are using hundreds of millions of ounces more silver every year than we pull out of the ground. How does a market function in a deficit? It drains the above-ground stockpiles. The registered silver inventories on the COMEX and the LBMA in London have been steadily bleeding out. They are structurally compromised. The buffers are gone. If this were any other commodity, if this were cocoa or uranium or copper, a multi-year structural deficit combined with a geopolitical supply shock would send the price up 50% in a week. But because it's silver, and because the bullion banks control the paper pricing mechanism, they are actively suppressing the price to cover their own massive short positions. They are trying to cover their tracks before the vault dry. Today's 7% drop wasn't a reflection of abundant supply. It was an act of desperation by paper shorts trying to shake out weak hands so they can cover their positions at your expense. So where does that leave you? How do you survive this manipulation and actually build generational wealth? It requires an identity shift right here, right now. You must transition from a fearful, reactive speculator into a cold, calculated accumulator. You have to become the hero of your own financial rescue plan. Here is the exact playbook to beat them at their own game. Rule number 1, zero leverage. Do not trade silver on margin. Do not buy short-term call options. If you use leverage, you are handing the bullion banks a map to your stop loss. You are inviting them to rob you. When they flash crash the price by 7% like they did today, the leverage trader gets wiped out. The physical holder doesn't lose a single ounce. Rule number 2, buy weight, not rarity. Forget about fancy numismatic coins with huge premiums. Your goal right now is sheer tonnage. You want low premium, highly liquid bullion. 10-ounce bars, 100-ounce bars, sovereign coins when the premiums are reasonable. You are not a coin collector. You are building an alternative central bank in your own home. Rule number 3, if you can't hold it, you don't own it. Stay away from unallocated paper silver accounts. If you absolutely must use an ETF for liquidity in your retirement account, make sure it is a fully allocated, physically backed trust that actually takes metal off the market, not a derivative scheme that just plays with paper contracts. When they engineer a 7% drop, you do not panic. You smile. You log into your bullion dealer, or you drive to your local coin shop, and you trade your depreciating fiat dollars for real money. You use their manipulation to lower your average cost. You bleed their physical vaults dry, 1 ounce at a time. We are entering a phase of the global economy that most people are completely unprepared for. Gold at $5,310 is the alarm bell ringing in the night. It is telling you that the fiat system is fracturing. The 10% spike in oil is the match being dropped on the inflation fire. And silver? Silver at $88.50 is the greatest, most asymmetric mispricing of an asset in modern financial history. Do not let them shake you out. Do not let the mainstream media convince you that a strictly industrial metal is useless during a wartime energy crisis. The rubber band is stretched to its absolute breaking point. When the physical shortage finally overrides the paper manipulation, the move in silver will be so violent and so fast that if you aren't already holding your position, you will be permanently priced out. If you want to stay ahead of this market, if you want the unvarnished truth about what the banks are actually doing behind closed doors, you need to hit that subscribe button right now. Turn on the notification bell, because I am tracking these physical vault drawdowns daily, and the moment the dam breaks, my subscribers are going to be the first ones to know. Share this video with anyone who is panicking today. Send this to the people you care about who are holding silver and considering selling at a loss. They need to hear the truth before they make a permanent mistake. Now let's have a brief moment of absolute clarity between adults. I am a researcher. I analyze macroeconomic data, supply chain metrics, and market psychology. I am providing you with the data that Wall Street ignores so you can see the chessboard clearly, but I am not your personal financial advisor. I don't know your risk tolerance, I don't know your time horizon, and I don't know your bank balance. Investing in precious metals, especially physical commodities, carries inherent risk. Markets can remain irrational longer than you can remain solvent. The paper manipulation we discussed today is real, and it is ruthless. It can happen again tomorrow. You must do your own due diligence. Never invest money you need to pay your rent or feed your family. Use this data as a weapon in your own research arsenal. Take radical responsibility for your own financial future and make the decisions that are right for you. They want you poor, scared, and reactive. Choose to be wealthy, prepared, and ruthless. I'll see you in the next video.